Hey everyone, welcome back to the channel. Have you been watching your investments closely this week, or perhaps wondering what the latest economic headlines mean for your everyday finances? Well, buckle up, because the signals coming out of the Federal Reserve right now are poised to directly impact your wallet, from your mortgage to your auto loan, and there's a fascinating dynamic at play within America's central bank that you absolutely need to understand. This week has seen some significant shifts, with two high-ranking Federal Reserve officials, both appointed by President Donald Trump, signaling a potential interest rate cut as soon as the very next meeting in July. Federal Reserve Governor Michelle Bowman on Monday said she would favor an interest rate cut at the next policy meeting, provided inflation pressures remain contained. Her remarks in Prague echoed those made by fellow Governor Christopher Waller just last Friday, who also suggested the Fed could consider lowering its key interest rate next month. This isn't just a subtle hint. It marks a notable departure from the more cautious stance held by Fed Chair Jerome Powell, who had previously indicated the central bank would maintain a wait-and-see approach, closely monitoring the economy and how inflation responds to tariffs over the summer before making any moves. The Fed's next policy meeting is scheduled for July 29th and 30th. Now, why are these officials suddenly pushing for a cut? It boils down to their assessment of inflation and the labor market. Bowman and Waller are downplaying the long-feared inflationary impact of President Trump's tariffs. Remember those tariffs? Trump has imposed a 10% duty on nearly all imports, an additional 30% on goods from China, 50% on steel and aluminum, and 25% on autos. Economists widely worried these import taxes would spike inflation and depress growth. However, Bowman stated that it's likely the impact of tariffs on inflation may take longer, be more delayed, and ultimately have a smaller effect than initially expected. This is partly because many firms front-loaded their stocks of inventories. The latest government data shows that the Consumer Price Index ticked up just 0.1% from April to May, a sign that overall price pressures remain muted. Year over year, prices rose 2.4% in May, slightly up from 2.3% in April, but still far from a runaway surge. Bowman believes that any upward pressure from higher tariffs on goods prices is being offset by other factors, and that the underlying trend in core inflation is moving much closer to the Fed's 2% target than current data overtly shows. Beyond inflation, a growing concern for both Bowman and Waller is the health of the labor market. While the job market is still considered solid, they're starting to see signs of softness. Bowman specifically noted that downside risks to the employment mandate could soon become more salient, citing recent softness in spending and signs of fragility in the labor market. For his part, Waller pointed to rising unemployment among recent college graduates as a signal of potential weakening. Their argument is clear. Why wait until the job market tanks before cutting rates? It's better to act proactively to sustain a healthy labor market, bringing the policy rate closer to its neutral setting. This shifting sentiment within the Federal Reserve is causing ripples across financial markets. On Monday, U.S. stocks rallied, with the S&P 500 rising 1%, the Dow Jones Industrial Average adding 374 points, and the Nasdaq Composite gaining 0.9%. This surge was partly fueled by the dovish signals from the Fed. At the same time, oil prices tumbled, with benchmark U.S. oil dropping more than 7% to $68.51 a barrel after briefly topping $78 on Sunday night. This significant drop in oil prices was driven by hopes that Iran will not disrupt the global flow of crude oil, even after the United States' entry into its war with Israel. Even despite weekend headlines involving U.S. strikes on Iranian nuclear sites and Iran's missile retaliation, analysts noted that Iranian oil exports through the Strait of Hormuz have shown no signs of slowing down. Traders are calming down, looking beyond the immediate bombs in the Middle East, signaling that without a broad regional escalation, the impact on physical oil markets could stay contained. Treasury yields also fell in the bond market as investors position themselves for potential rate cuts sooner rather than later. While traders are assigning a low probability, around 23%, to a rate cut at the July meeting, the likelihood of a cut by September is much higher, around 78%.
For the average American, these potential rate cuts could offer some relief, especially concerning borrowing costs. When the Fed lowers its short term interest rate, it often translates into lower borrowing costs for things like mortgages, auto loans, and business loans. However, it's important to note that financial markets don't always perfectly follow the Fed's short term rate changes, and longer term rates can sometimes remain higher due to other market forces. We saw this last year when the Fed cut its rate by a full percentage point to around 4.3%, but mortgage rates only declined slightly. Speaking of the housing market, May home sales barely budged. Existing home sales edged higher by 0.8% from April to May to a seasonally adjusted annual rate of 4.03 million units, but they actually fell 0.7% compared to May of last year. Stubbornly high mortgage rates and rising prices are making home buying less affordable, even as the inventory of properties on the market continues to increase. The national median sales price for existing homes in May hit an all-time high of $422,800. Any reduction in the Fed's policy rate could potentially alleviate some of this pressure, making homeownership slightly more accessible. This whole situation is underscored by ongoing political pressure from the White House. President Trump has relentlessly criticized Fed Chair Jerome Powell for not cutting rates more aggressively, even resorting to strong language, calling him a numbskull and a fool. Trump argues that lower rates would significantly reduce the government's borrowing costs on the national debt, which currently stands at around $36 trillion. While the rates the government pays are largely set by market forces, not solely by the Fed, the administration continues to press for lower rates, believing that less restrictive regulations, lower business taxes, and a more friendly business environment will ultimately boost supply and offset any negative economic effects. This creates a challenging environment for the Fed, which prides itself on its independence from political influence, yet is now seeing two of its high-profile members, both Trump appointees, aligning with the president's public demands. So, what does this all mean for you? The convergence of a potentially more dovish Federal Reserve, a relatively contained inflation picture despite tariffs, and a labor market showing early signs of softening suggests that lower borrowing costs could be on the horizon. This could impact your ability to finance a home, buy a car, or even expand a small business. Keep a close eye on the Fed's July meeting. The debate within the central bank is heating up, and their decision will have direct consequences for the broader economy and your financial well-being. Thank you for tuning in and staying informed on these critical financial developments. If you found this helpful, hit that like button and consider subscribing so you don't miss our next update. We'll be here to break down all the latest news as it happens. See you next time.